Hello, everyone. It's my great pleasure to welcome you back to our More Than Market series. My name is John Bay, Senior Vice President and Chief Investment Officer for NEI Investments and Aviso Wealth. As promised, we're going to shake things up in 2022. We're going to continue to bring you timely market and ESG updates, but we're going to do them through a series of short weekly videos. So let's jump straight into this exciting content that we have prepared for you today. Last week, we had a full day of training and a due diligence event with some of our key sub-advisors. And I wanted to share with you a few of the most important takeaways from this sessions. So let's start with bonds because they seem to be the subject of most worry for most investors. We'll start with the NEI Total Return Bond Fund. This aptly named fund seeks to generate a positive absolute return in all market conditions. And how do they do this? Well, as a $2 trillion manager, they have the scale to tap 6 sources of alpha that may not be available to other bond managers. These sources of alpha include credit, high yield, emerging markets, currencies, duration, and yield curve positioning. And so the more important question is, how are they positioned to protect investors in a period of high inflation and rising central bank rates? Well, in multiple ways. They have invested in inflation-linked bonds in the US, Europe, and Australia. They're overweight currencies of commodity-linked economies. They're also underweight the US, a region which has one of the highest rates of inflation. They're also underweight duration to protect against rising bond yields, and they have reduced risk across the portfolio in preparation for a more risky environment. For instance, they've taken down their emerging market exposure and put on some risk protection where it makes sense. So as you can see, the portfolio is uniquely positioned to add alpha in what we're expecting to be a very tough 2022 year for fixed income investors. Moving on to the NEI Global Impact Bond Fund, this is another unique bond fund that measures its positive impact on the planet and people. This fund has a very high bar for investing. They don't just rely on labeled bonds like green bonds, but they have the expertise to assess what bonds actually are having a truly positive impact on the environment and on the society. They also have the resources to assess bonds that are trading at a fundamentally attractive price. Why is this important? It's because many labeled green bonds trade at a premium, the so-called greenium. And in order to avoid overpaying for impact bonds, Wellington is able to buy non-labeled bonds that often trade at a discount, not only to their green labeled counterparts, but generally trade at a good value as well. This fund's had a really good start and has added value over its benchmark over 1 year and since inception. So how do they do this? Well, one way is to be overweight municipal bonds. These bonds are help fund things like non-profit hospitals, for instance, that have great social impact in the years of a global pandemic. They've also benefited from fiscal support from federal governments. Another good example of a muni bond that they picked up in the fourth quarter is the City of Vancouver bond. This bond provides funding for activities such as electric vehicles, energy efficiency of buildings, and also affordable housing. So again, we look forward to another great year of measuring positive impact for people, planet, and profits. So moving to 2 other funds in our impact suite of products, the NEI Environmental Leaders Fund. This was one of the first funds in Canada to measure its positive impact on the environment in every year of its existence. Annual reports provide metrics on how much CO2 was saved, water saved, and waste material saved, for instance. So it's had a positive impact on the environment, but how is it positioned to add value in a high inflation and a rising central bank environment? Well, first of all, they have no exposure to the hyper-growth names that are the hardest hit by rising interest rates. Second, they have a very strong focus on quality. Their process ensures that this fund is invested in companies that have strong margins, strong balance sheets, and trade at reasonable valuations. And these are exactly the type of companies that tend to do well in rising interest rate environments. And finally, they have strong tailwinds. Remember, they're investing in companies that aren't just strong ESG companies, but are also enabling the transition to a more sustainable economy. A good example is Linde. This company is a leader in wastewater. As global consumption of water increases, the challenge of providing clean water also increasing. With leading edge products, they treat both industrial and municipal wastewater to ensure that they meet rising regulatory standards for clean water. They also have, importantly, they also have contracts that are linked to their input costs, which help protect against inflation. They're also a global leader in green hydrogen, and and the company is also experiencing one of the strongest demand for their products ever, perhaps. And so this fund has had good returns. And so let's move on to the Global Sustainable Balance Fund. This fund is a 60-40 mix between Environmental Leaders Fund and an impact bond portfolio that is also managed by Impacts. The impact portfolio, again, is also focused on bonds that provide a positive social and environmental impact. Impacts has developed a really unique proprietary sustainability rating framework that looks at 17 ESG risks and opportunity categories. And when they backtested this framework against their corporate bond universe, they found that it had a proven record of adding value. And so, with that tool, they're able to, again, provide alpha over their benchmark. For instance, one way of doing that was focusing on the asset-backed security sector. A good example of that is Tesla auto loans. And so while Tesla auto loans absolutely taps the growing electric vehicle market, it's a credit base, and the credit base is actually based on consumer credit of Tesla buyers. And so while the ABS has an attractive yield, Tesla buyers also have consumer credit ratings that are one of the highest in the market, which isn't surprising at all. So it's a good example of how the fund is overweight high quality credit, where the coupon is enough to offset potential increases in interest rates. Another great balance fund that has stellar performance since its conversion to an impact balance, and we expect that to continue. So the NEI Global Equity RS Fund. This is probably a very strong ESG integrated fund. It's managed by Federated Hermes, who has one of the largest ESG corporate engagement teams. The fund tends to be fairly sector neutral. So its outperformance generally comes from active stock selection. So how is it positioned for 2022? Well, it's a low carbon tilted portfolio with lots of exposure to energy transition names. So they have a good macro tailwind as countries and companies start to transition to a net zero economy. They also have a very strong focus on quality. Since this fund has very strong quantitative foundation, they can actually control the factor exposures that they have. Currently, they have a high quality bias with higher than market return on equity, higher than market net margins, and earnings momentum. They also have a strong balance sheets with a better than market balance sheets, as well as valuations that are better than lower than the market as measured by PE, price to cash flow, and price to sales. And these again are all metrics that are expected to outperform in a volatile market in 2022. And last but not least is the NEI Emerging Markets Fund. This is one of the few ESG emerging market funds in the marketplace right now. Why is that important? Emerging markets is already one of the best markets for active managers with good data scarcity. There's lots of inefficiencies in emerging markets that can be exploited. ESG is the same story. Studies have shown that ESG has one of the biggest impacts in the emerging markets area. And Columbia Threadneedle, the fund's sub-advisor, has done a great job to fill in the ESG data gap that exists. Their data science team has been able to tap billions of unstructured data points to come up with a proprietary ESG company score. And from that perspective, they have a great informational advantage. So the emerging markets generally has moved from a cyclical market 15 years ago to a strong growth market, a secular growth market. And this emerging market fund has taken advantage of that shift with a strong growth bias. It has been hit recently, but its strong 3-year numbers show that they can manage a fund effectively over a full market cycle. So quick summary points. All funds are well positioned for a more volatile year, given the environment of higher central bank rates and high inflation. To mitigate this volatility, the managers are focused on very high quality securities with strong earnings, cash flow, and balance sheets that trade at attractive valuations, and all employ ESG to help limit downside risk and add alpha. So thank you for tuning in. We hope you found today's update helpful. Watch out for next week's edition of our More Than Market video series. And as always, reach out to your local NEI representative if you have any questions or feedback. Thank you so much and stay safe.